So in this video, I want to consider how to pick dividend-paying stock for the long term dividend reinvestment plan. You want to consider the kind of stocks you will pick for the long time, considering dividend reinvestment plan growth. So how do you go about that? Number one is steady dividend payments. Is a critical factor when it comes to picking dividend-paying stocks for this plan. You consider, consistent payment history, consistent dividend payment history. So you look for companies with a strong kind of history, strong history of paying and paying reliable and consistent dividends over time. So companies that have a track record of paying dividends for many years, preferably decades, are more likely to continue paying and increasing them. Some companies are called dividend aristocrats because of their dividend history. They've been paying dividends for many, many decades, many years. Number two is strong financial health. You consider the financial health of the company. In other words, you look at its fundamentals. You look at the balance sheet. How solid is the balance sheet? So you choose companies with a healthy balance sheet, including low debt levels, high cash flow, and profitability. A financially stable company is better positioned to sustain and grow its dividends payout, which is critical for the success of the dividend reinvestment plan. You also consider sustainable payout ratio. So you look for companies with a manageable payout ratio. The percentage of earnings payout as dividends is what is called payout ratio. All right. If the earning is, let's say the earning per share is $10 and the company pays $1 as dividend, that's a payout ratio of 10%. That's 10%. And so a payout ratio that's too high could be unsustainable, while a moderate to low ratio suggests the company is reinvesting enough dividend to fuel growth and maintain dividends. So it all depends. In a case where the company is paying less dividend, it could be kind of funding its growth and cannot afford to pay an increased amount and level of dividends. Number three is a steady earning growth. Steady earning growth. In other words, you have to consider the company's earning. It must have consistent earnings. So companies with stable and growing earnings are more likely to maintain and increase their dividends. So you look for businesses in sectors with steady demands and growth potential, such as utilities, such as consumer staples, as well as healthcare and other blue chip companies. There should be, that revenue stability. You determine how stable is a company's revenue. So you favor companies that exhibit stable revenue, and in that case, you talk about the idea of the company's revenue being sustained. There's an increasing revenue year in, year out. So volatile revenues might indicate risk, which could affect the company's ability to sustain dividend payments. In a case where there's fluctuation in sales or revenue, the company might end up not being able to pay dividend at the end of the financial year. There could be a dividend cut. Number 4 is dividend yield. There should be an attractive dividend yield. For the stock to qualify, it must have an attractive dividend yield. The dividend yield is the annual dividend payment divided by the stock current price. All right. So if you divide how much is the company paying as dividends, divide that amount by the company stock price. Okay, that will give you the dividend yield. So you look for stocks offering a competitive yield that align with your income goals, but also consider the sustainability of the dividend. How sustainable it is, not just by can the company sustain that level of dividend payouts. So you avoid overly high yield. It should be a kind of middle of the road policy. So avoid the ones that are too low and equally avoid the ones that pay at too high a level of dividend. So maintain a kind of, a level of a middle of the road policy kind of. So extremely high dividend yield can be a red flag as they might not be sustainable. It might be a one-off affair, a one-off event. So an unusually high yield could suggest that the company is in financial distress or that the stock price has fallen significantly, which could signal trouble. There's one thing about dividend yield. The lower the stock price, the higher the yield kind of. Okay? If a company that is selling for $10 per share gives a dividend yield of maybe gives out dividends of $1. If the company stock falls to $5 per share and still gives out $1, you discover that the yield is much, but it indicates that there's something, not favorable with the company somewhere. So number 5 is dividend reinvestment opportunities. Reinvestment opportunities. So in this case, there's no transaction fees. So as you reinvest your dividends, you don't pay for transaction fees, you don't pay commission. That is something very interesting about this plan. So many companies and brokerage provides, this particular plan that allows investors to automatically reinvest dividend without paying commissions, making them more cost effective. You also have that ability to participate in fractional share purchases. It ensures the company offers fractional shares purchased through this plan, allowing dividend to be reinvested in small amounts, even in a case where the dividend paid cannot buy, a full units of the company shares. You can be a fractional owner, fractional ownership. Number 6 is sector stability. Sector stability. So in this case, you consider defensive sectors. Companies in defensive sectors like utilities, healthcare, consumer staples tend to perform better during economic recessions, making them to be safe for this particular plan. These sectors typically offer reliable dividends and lower volatility. You also go for low volatility stocks that don't really show a high level of volatility. Whose volatility is considered whose beta is considered at I think 1 or less than 1. 1. Okay. So fewer companies with relatively stable stock prices, and this plan would it will favor companies with lower volatility. It's a very good candidate. Number 7 is dividend policy. Dividend policy, you have a long-term commitment to dividends. It's a long-term commitment to dividends. So Look for companies that emphasize a long-term commitment to paying dividends. Many companies with established dividend policies prioritize shareholders and consider dividends a key part of their value proposition. They have their customers at heart, their shareholders at heart, and they will do everything possible to satisfy them by paying regular dividends. You know. So you focus on dividend aristocrat or king. Some companies are known as are called dividend aristocrats. They've been paying dividends for many years, some even more than 50 years. They keep paying dividends. These are the kind of companies you consider because they're not likely to cut their dividends. So you consider number 8, tax consideration. You need to have a tax deferred account like a 401k or an IRA account. That will help you to benefit from tax exemption. Number 9 is growth potentials. You balance growth and income. While dividends are important, it's also essential to choose companies with growth potential. Don't just go for dividend. No, does this company have room for growth? You need to ask yourself, not just dividend payout alone. So you have a company that's not only paying dividend, but the company is growing at an appreciable rate. That's a very good candidate. So look for companies that have solid business models, competitive advantages, and a prospect for future growth, as this will provide both dividend income and price appreciation at the end of the day. So don't just consider dividends. You need to also look at growth in your overall strategy.